$140 million in short positions, gone in 24 hours. Bitcoin just ripped from $63,000 to $69,000, while the fear and greed index sat at 5 out of 100, a reading we haven't seen since the FTX collapse. Meanwhile, a lawsuit dropped that may have just exposed who was secretly dumping Bitcoin every morning at 10 a.m. In the next few minutes, we'll connect a hidden trading pattern, a $40 billion ghost from 2022, and a flood of ETF money to show you what's really driving this rally, and why most people are looking at the wrong signal. Imagine a dam holding back a lake. For 5 straight weeks, water has been draining out $8 billion pulled from Bitcoin ETFs, the longest outflow streak since these funds launched. Prices fell nearly 50% from October's all-time high. The sentiment index crashed to 5, matching the darkest days of the FTX era. Crypto Twitter was writing obituaries. And then, on February 25th, the dam reversed. Bitcoin surged 7% in a single session, its best day in 3 weeks. Nvidia's blowout earnings sent risk appetite soaring, and $507 million flooded back into Bitcoin ETFs in one day. But that's not the interesting part. Here's where the story takes a turn nobody expected. The obvious take: Nvidia crushed earnings, tech rallied, crypto followed, just another risk-on bounce. That sounds clean. It's also dangerously incomplete, because Nvidia's earnings hit after hours on February 25th, but Bitcoin had already started climbing before that. The rally began hours earlier, right after a lawsuit landed in Manhattan federal court. And that lawsuit didn't just target any firm. It targeted Jane Street, one of the most powerful trading operations on Wall Street. So what's really going on? The real story, 2 unexpected angles. Here's what almost nobody is connecting. The Jane Street lawsuit may have accidentally killed a systematic selling pattern that was suppressing Bitcoin's price for weeks. Terra Labs bankruptcy administrator filed suit claiming Jane Street used insider information to front-run the 2022 Terra collapse, allegedly withdrawing $85 million from Curve 3 pool minutes after Terraform secretly pulled $150 million, helping trigger a $40 billion wipeout. Jane Street allegedly avoided over $200 million in losses while retail investors got destroyed. Now here's the twist that matters today. Analysts at the block flagged something remarkable. Bitcoin had been experiencing a consistent 10 a.m. slam pattern, a sharp dip almost every morning around 10 a.m. Eastern, consistent with systematic institutional selling. The day after the Jane Street lawsuit dropped, that pattern stopped. Dead. Think about what that implies. If a major trading desk was regularly applying selling pressure at predictable times, whether it was Jane Street or firms reacting to Jane Street's positioning, the legal exposure from this lawsuit may have forced a sudden change in behavior. Not because anyone was found guilty, just because the spotlight turned on. And when that selling pressure vanished, shorts were suddenly exposed. Over $92 million in short positions got liquidated in just 4 hours during the breakout past $69,000. If Bitcoin pushes past $69,600, another $600 million in shorts faces forced liquidation. That's not a bounce. That's a loaded spring. But that's only half the story. The second angle is even more counterintuitive. Retail investors may be smarter than institutions right now, and the data proves it. While Bitcoin ETFs were hemorrhaging money for 5 consecutive weeks, something bizarre happened on Google. Searches for Buy Bitcoin hit a 5-year high. Bitcoin, as a search term, surged to levels not seen since the 2021 bull run. Retail was researching and buying, while institutions were selling. Wait, it gets better. On February 24th, one day before the big rally, ETF inflows suddenly flipped positive, $257, 7 million in a single day, the largest since early February. The next day, $507 million more. That's a $765 million reversal in 48 hours after 5 weeks of outflows. Institutions didn't lead this recovery. They chased it. This flips the conventional wisdom completely. We're told institutional money is smart money and retail is dumb money. But the fear and greed index hitting 5, the same level as the FTX collapse, while Bitcoin was trading at $63,000 to $65,000 may turn out to be one of the most obvious bottoming signals of this cycle. K33 Research compared current conditions to the late 2022 bear market bottom and called current levels attractive for patient investors. The people Googling "buy Bitcoin" at the peak of fear may end up being right. Drop a comment if you saw this. This matters beyond trading screens. If the Jane Street lawsuit proves that major firms were manipulating crypto markets with insider information, it sets a legal precedent that could reshape how institutional players operate in digital assets. More accountability means more trust. More trust means more mainstream products, tokenized assets, crypto-linked ETFs, and payment rails that regular people use without even knowing they're touching blockchain technology. But here's the uncomfortable question. If a firm can allegedly avoid $200 million in losses using insider knowledge while retail loses everything, is the playing field actually getting fairer or just better at looking fair? Bitcoin is now staring at $70,000, a level loaded with $600 million in potential short liquidations. If it breaks through, the squeeze could accelerate violently toward $75,000. But the fear index is still in extreme fear territory, which means conviction is thin. The Jane Street trial will unfold over months, and every filing could move markets. The real question: if fear is this extreme but prices are already recovering, what happens when sentiment finally catches up?